Greetings from ADK Wealth Advisory Group. During these most grim of times, our prayers go out to those who are really most affected by COVID-19, those who are experiencing the illness, those families who have lost a loved one, our medical community that's on the front line of this battle, those who have lost jobs in staggering proportion, and you, our clients, who have felt this both emotionally and financially. Our focus today is on the COVID-19 bear market. If you have watched many of our videos over the last year, what you've seen is we've been preparing for a market pullback. We knew that we were late in an economic cycle. We anticipated a recession, and as a result of that, a bear market that would come, say, 3 to 9 months before that. The article that I posted on our Facebook for ADK Wealth Advisory Group February 12th through MarketWatch. If you haven't read that, I would highly recommend it. I'll read the title. Goldman Sachs analyzed bear markets back to 1835. The article did some really positive things. First is it categorized bear markets in 3 ways. First was cyclical bear markets. That's what we were expecting. Economics run their toll, end in recession, bear market prior to. Second, like we saw in 2000 and 2008, where you have a structural bear market, some kind of an asset bubble, stocks, real estate, leads to market collapse when the bubble burst. And then what we're experiencing right now would be categorized as an event-driven bear market. 2 main points that the article makes is how severe of a pullback has this really been in the past. And so we'll focus just on the event-driven. Historic average of event-driven bear markets has been around 29% pullback. One does not know where we sit right now what ours will be, but if it ended today, our high would be March 19th, our high would be February 19th, and our low would be March 25th. And that pullback was 33%. So fairly close to being in line with the average. Again, we don't know because we're not through this yet. The average duration from peak to trough to peak historically has been 15 months. We're really monitoring things like new cases, deaths, to really evaluate, does our curve of new cases and deaths look like China's and South Korea? If so, I think thinking of it in terms of 15 months is pretty reasonable. If it doesn't go that way and it were to elongate out or do something like this and have a double dip, I think the financial markets and the economy would suffer and the time frame would be longer than the average. What's interesting around some of the key points of this is how bad does the stock market get hurt? If you go back to the Spanish flu, 1918 to 1920, the stock market actually had positive returns in the midst of that. The theory that I've been able to most follow is that it wasn't because of the Spanish flu, but rather that we were finishing World War I and the positive momentum that the stock market had from that sort of pushed through the negative that would have been there from the Spanish flu. MarketWatch did an article back February 24th, how the stock market has performed during past viral outbreaks as coronavirus spreads to Italy and Iran. Authors Mark DeCambry. And DeCambry talks at length about all the different viral outbreaks from the 80s through this. Interesting to me that whether you look at SARS, whether you look at the swine flu, many of those viral outbreaks, the Dow Jones actually had a positive return. There was only one during that period of time that had a negative return, and that was in the 80s when the HIV virus was breaking out. And that didn't even register as a bear market. The market was down 16%. Again, one doesn't really know what ours is going to look like. Our strategy, as I alluded to earlier, is staying the course or for more aggressive clients buying in. That strategy will hold to be very well if some of the different solutions that have been put in place work out. So what are those? You had monetary policy that in the month of March, you had 50 plus different central banks throughout the globe pull a variety of different levels. Some only one, and that was interest rates. But if you take a look at the Fed, they pulled 8 different levels, layers, if you will, and it was absolutely astronomical what they did. Some of what they did, I didn't even know they had the ability to do. Now, the effect of that wasn't as great on the stock market, but it really did help what was happening in the bond market. It kind of went unnoticed because the stock market was catching all the headlines and was so severe. The most important thing that the Fed did is they said that they'll do whatever it takes, and they are being the lender of last resort. Now, when it comes to government policy, we'll start with fiscal policy. The $2 trillion plan and stimulus that was rolled out was pretty significant. It's not going to be enough, but it exceeded most people's expectations. Other countries are following suit, ranging from the UK to Australia and Japan. Another is what I'll call is transparency. If you go back to the Spanish flu, it was the exact opposite of transparency. Again, the theory coming off of World War I, the Western civilization, the governments were tenuous about how the morale would be influenced, so they used warlike media suppression to make sure that no one was able to communicate from the press on it. However, Spain was neutral in the war, and as a result of their neutrality, their media press did actually communicate quite a bit about it. So the world kind of thought it was just going on in Spain. That lack of transparency and the lack of government intervention really caused it to spiral out of control to the point where about 25% of the population was infected, and the death toll was staggering. So far, from what I've read in the CDC website, it goes down as the worst viral outbreak of modern history. Last with the government is the whole policy ranging from what China did, where they lock it down, to quasi-lockdowns that you've seen in places like New York, to national social distancing. It's much needed. We'll be able to determine in hindsight whether it was enough. So far, the transparency, the social distancing, the lockdowns are a major part of how we're making sure that this doesn't continue to spread. And our medical system, primarily looking at the hospitals, is being taxed beyond all imagination. The work that they're doing to help the ill and to avoid rapid spread is greatly appreciated. It's a very, very important component, and I know it's all hands on deck. Again, our prayers go out to our healthcare providers. In conclusion, we're anticipating that America and the Western world will see a trend of new cases and deaths like what we saw with China and like what we saw with South Korea. If it happens that way, then I think that our strategy will play out well. If it does not happen that way and it gets elongated, or if we get that double dip, we will have to rethink our strategy based on what happens with the financial markets, and we're anticipating, looking, monitoring, et cetera. The volume of unemployment is staggering, but it's expected in the midst of the shutdown that's happened. And again, for our strategy, what we're thinking is you stay the course or you use this as a buying opportunity. In conclusion, I just want to thank you very much for the trust that you're placing in us. We value that very much, and we want to send our prayers out to you and to your family. The ADK Wealth Advisory Group team and our families have all been healthy and safe. Thank you, and signing off.